Good morning, everyone. Welcome to the opening playbook for Thursday, September 4th, 2025. Hey, Mike, how you doing? Hope everybody's having a good start to your day. We're going to get started with some pre-show content in just a second. Give everybody a chance to get in here, pay attention, and we'll get going. Hey, Hank. Looks like we have a little bit of a green day going in the market so far. That's nice to see. All right, let's get started. For those of you that are here for the first time, Opening Playbook is a free daily live webinar that we do every morning at 10 a.m. Eastern Time, Monday through Friday when the market's open. We try to provide a timely market review and some trading education. The stars of the show are Graham Lindman and Nathan Tucci, and we try and focus on market overview, trade ideas, daily Q&A with all of you, some live trading from time to time, and occasionally some special guests. When you come to the platform here to get into the webinar, you do not need to click on the login link. You just need to put your display name in there and click join. Once you get into the webinar, in the top left corner, you'll see the hamburger icon. That's the little three bars. You can click that to shrink the green area on the left and give yourself a little more screen real estate for the presentation. In the bottom left corner, you'll see a speaker icon that can be used to mute or unmute the audio from the presentation. So if you can see us but not hear us at all, try that button. Make sure that you don't actually have us muted. In the bottom right corner are two icons that can be used to change the size of the presentation. The double arrow button will make the presentation full screen. This will hide the announcements and the chat, but will give you the most visibility on the display. And next to that is the picture in a picture button that will shrink the presentation into a little floating window so that you can do something else in the window behind it, like maybe flip to your brokerage account or pull up a web page, that type of thing. This is both browser and platform or device dependent. So you may not be able to do it using all browsers or all devices. You can definitely do it using Chrome on a PC. And so Chrome seems to be the browser of choice if you want the picture in a picture functionality, but go ahead, give that a try if you're interested in maybe using your phone or a tablet and doing something else in the background while still watching and listening to the presentation. Below the presentation, you'll see a little slider button called low latency. This is yellow when it's on and white when it's off. And we recommend that everybody turn it off. This will give you a better quality audio and video presentation. And lastly, if you want to send a private message to any of the hosts, being Nathan, Graham, or me, you can hover over or tap on any of our messages in the chat and then click on the double speech bubble icon that you see on the slide there. That double speech bubble icon will give you a tab to send a private message to whoever you're clicking on. So you can use that to ask a question that you don't want to ask in front of the whole audience, or maybe send us your personal information like name, email, phone number, that kind of stuff, without telling the whole crowd. If you haven't seen it, check out our new and improved replays page at the URL you see on your screen there. It's also in the links below the presentation in the announcement section. Here is an image of those links. The first one is the URL that you should be using to get to opening and closing playbook. It will always take you to the live page. The second link is the one we just previewed, which has the most recent replays. Those replays go back to about mid-August, and they will continue to build going forward. So in the future, that will probably be the only link you'll ever need. But since we're still, less than a month into that new page, some of the older but still fairly recent replays you might want to see are found on the third link here, the youtube.com/@newmoneycrew page. Those won't be complete replays, but you'll be able to get some of the older content that is not available in the new library. The next link is something you should definitely click on if you don't already get our daily scan email. That's the New Money Crew daily scan. It is not a scanner product. It's just what we named the New Money Crew daily email that gets sent out. It's totally free, and New Money Crew is the grouping of Nathan, Graham, and Lance Ippolito. So they all have stuff that they put together in that daily email. We also have links to the Telegram channels for Nate and Graham. Also, something you should get if you don't already have it is the $1 VIP Playbook membership. That is literally just $1 and will give you forever access to a lot of resources in our members area, training, tutorials, online calculators, all kinds of cool stuff that go along with the opening and closing playbook sessions. And then I have some links to some other content as well that might be helpful to you. Coming up today on Opening Playbook, we will see at least Graham, I think Nathan as well. We're going to be talking about gold dipping again. Graham's going to be doing a wrap order training. So if you're not familiar with, or even if you are and you just want some more education on wrap orders, that would be a good thing to watch. Here we will be doing some live trading today in Opening Playbook, and we'll be taking a look at Graham's on the clock stocks program. And that's all there is for the pre-show. Let's get going with the theme song.
Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk side. Options in place in a live display. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk side. Options in place in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh, step by step they break it down. No confusion, no spinning around. With every trade they set the tone. Making big calls from their trading throne. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh.
All right. Welcome everybody to the morning opening playbook for September 4th. Hey guys.
Hey.
Hello. How's everyone doing?
Nate, we're matching today.
Thursday. Dude, Thursday already. Yeah, we should share from our photo shoot that we had in the office recently. Where we
Yeah.
I actually have one of those pictures in the slide deck, the opening playbook slide deck.
Nice.
Wait, that's the wrong one, Dave.
That looks pretty cool.
I know. There's the one where you lost 12 pounds or something, and yeah,
I think I lost about 30 pounds in the other one.
You look really good here too, Nathan. Don't worry.
It's
You'll never look as good as Graham, but you look good in that one.
I'll never look as good as Graham. It's what I have to live with.
Yeah.
You'd have to go to the gym occasionally.
Yeah, we're not doing it, Dave. But yeah, first of all, I can't believe it's already September 4th. Second of all, yes, they really did make Graham and I take pictures when we were in the office together because we're very rarely together in person. So they forced our hands. But lot going on in the markets, and yet feels kind of stable again. It's a weird market environment. We got a couple big shifts, and now market, what is it, 0.2% right now, not a whole lot. Graham, your hood is starting to rip back up. By the way, I once again told myself I was going to buy it at $100 a share and didn't. It's already up 3% since then. So this is like 3 times I've now done that and wish I did. So next time, Graham, it's at $100. I'm definitely going to.
Hey, Progressive just popped above the 50-day moving average for the first time in what feels like an eternity.
I know.
That is one that I've been holding. It's a great stock in the long run. It's trading at a discount if anyone's interested.
Yeah.
It's been a multi-week of just, man, when is this thing going to start going? But that's why I got a stock position, not options on it.
Yeah, it showed some signs of life like 4 different times and then kind of faded. But I agree. I think it's a long-term position. I also would, not be trading options, I don't think right now on it until maybe it pops above 260 and starts really going, because it actually is a great stock to trade options on once it gets some real momentum. But right now it's kind of in that lazy move. And we'll see what Progressive can do. Progressive, the reason I'm holding it, the reason I like it is because it's traditionally a stock that can be defensive and go up even in tougher market conditions, but also go up and make new highs when the markets are bullish. And so I wanted a big piece of my portfolio to be in a stock like that because I'm very aggressive on a lot of the other top moving stocks across the rest of my portfolio. And so I paid the price for that the last, couple of weeks, but like you said, it's underlying shares. So that the price isn't any losses. It's just patience and annoyance. But hopefully we're getting a turnaround. Speaking of Progressive, Graham, I made a huge mistake in the opening playbook yesterday, and no one in the chat, at least that I saw, even let me have it for it. I kept saying I was going to get to a trade yesterday, and then I talked about the pullback, and then JD and I went right into his 2 Sigma strategy, and I never came back around and gave my trade. And unfortunately, it was Walmart, which let me see. Yeah, Walmart is up over 1% since yesterday. Oh, it's up about 2% since opening playbook yesterday. So that's my fault, guys. I messed you up there. Feel free in the chat when I say or post a Telegram, hey, I've got an idea or whatever, and then get distracted as I get into the education. Just say, hey, Nate, is there a trade? Or are we still doing a trade? Sometimes it might be there was a trade idea and I actually, it nullified. I'm actually not going to do it. Most times I'm just distracted moving on to a bunch of different things in opening playbook. But yesterday I 100% plan to give you a Walmart trade because we were talking about pullbacks, and I gave a Walmart example, Graham, where Walmart has moved basically nowhere in the last 18 months. But if you trade the pullbacks, you could have done really, really well. And Walmart was all the way down to like below $95 again, or actually right around 95, which I think is a great buying zone. It's ripped a little bit since then, and now we're already kind of near the top of the range at $100. So I'm not going to give you Walmart now because we're already back up to $100. But let me see. There was a couple other that were on that list. Costco, I think, was the other. Yeah, Costco's still lagging a little bit behind. So Costco, same idea, trading up toward $9.95. So let me give you that trade because I messed everyone up on Walmart and didn't give you that one. I'm not even sharing my screen right now. I'll just pop it in the chat because it's just a basic, like we typically would. Basic debit spread on cost. We're going to give it a couple of weeks here to make a move up toward the top of its range, kind of catch up to the move that Walmart just made right around $9.90. So let me grab that here. I'll post in the chat. I don't know if Graham, if you want to start sharing your screen or if you have anything else, but I just wanted to do a little bit of a makeup for that because I messed everyone up. And I apologize. Again, not intentional, just me being distracted there
I can tell you that a few people noticed they were just more patient than you might have thought. They messaged me during JD's presentation, in a DM, like, what about today's trade? So I just told them I guess we ran out of time. So
Well, my bad. I didn't intentionally run out of time.
You guys got to remember that anytime you get an opportunity, Nate's like a punching bag. So take shots whenever you can.
Graham certainly does. It works out great for him.
Yeah.
All right, we're gonna do the 972.50, 975 on Costco. I think I'm gonna give this a little extra time. I'm gonna give it to October. I might have to go to the $5 strikes to do it in October, but I think I can get a little more juice. Ooh, wow, never mind. Not as good. Going to October. Graham, the ROI on October 3rd versus September 19th is like a 50% ROI versus a 200% ROI.
Oh, wow.
So
October 3rd might be because the spreads will be a little bit wider on the weeklies for Costco than the monthlies.
Yeah, but it's $3.40 for the $5 spread versus 80 cents for the $2.50 spread.
Wow.
But let me go to the September 26th, see if we can split this guy down the middle. More like $2. All right. Yeah, I just want to make sure we were over 100%. We will try. We won't be able to sneak in before earnings on this one, but you can close it right before earnings. And this is, by the way, I don't mind doing that. It's kind of a little sneaky trick you can use, by the way, guys. If you're trading a debit spread up into earnings and you want to take your profit before earnings because you're up on the position, but if you're down on the position, just use earnings as kind of a way to bail you out, where if you get a pop, you still have a coin flip trade. It's a little bit of an advantage that you can use when you are trading spreads because, again, you take your profit ahead of time, don't risk it. But if you're down on the trade, use earnings as a potential catalyst because, anytime you're trading a debit spread, at least the way that I trade them, I'm willing to lose it all anyway. And so earnings don't really bother me a whole lot in that situation. Okay, let me give you the buy. The September 26, 970 cost call. Sell the September 26, 975 cost call. And the debit here should be around $2. I definitely wouldn't pay more than like $2.20 for this. Because you want to be able to get out for 100% even before earnings potentially, which, you want to get out for like $4 or something before earnings if you can, which means you need to leave some meat on the bone. So, if you pay $2.50 for it, now you have to get the full $5 value in order to make 100%. So I would only trade it if you can get in. Let me see if I can get in here for $2. I have it. Didn't fill instantly, but it's saying that the mark is right around there. So I'll be patient on that one. And give it a minute, but there's your Costco trade, your makeup trade for my Walmart mistake. Thank you guys for the patience and bearing with me on that. And like I said in the chat, if I kind of get rolling on something else and jump from thing to thing, feel free to say, hey, are we still doing the trade or whatever else, and I'll pause and get back to it. It's usually just a matter of trying to get through the agenda versus actually not meaning to do the trade.
Yeah, it's easy. It's easy to go down rabbit holes and then forget what it was that you were starting off to do, especially with how much live content we put out. So thanks for making up there. All righty, let me go ahead and pull up my screen. Today, what I'm going to do.
Sorry, I was just asking. The overnight option slammed the target. So if you took that yesterday, you should it would be worth like 95 cents right now. So you should be well out by now on the overnight option. Max said it's only a makeup if it works. Well, I guess, yeah. I guess I can't count the fake Walmart trade that moved without us as a winning trade. So,
that's like my seasonal pick of the week was on INSM. And I felt kind of bad because that morning it popped 7% and it's gone pretty much flat since there. So it's like, well, we gotta get these things in earlier.
Yeah. Yep. We'd love to be on with you guys from 9:15 to 4 p.m. to make sure we get them all in, but unfortunately, not.
We have to watch us eat lunch at our desks.
Yeah, exactly.
Wait a minute, you guys get lunch?
Yeah.
You know what's great? I actually get a lot of flack for it, Dave, but usually my wife will bring me down lunch. And so like a lot of times I'm on like, a FaceTime or a Zoom with, Josiah or someone like that. And this little hand kind of sticks through the door with a plate full of food. And I get some heat for it. Like, oh, wow. What kind of operation are you running there? But it's
Right.
nice. She knows I'm busy and I'm often on calls. And so little delivery service here at the 2G
Unfortunately,
household.
she doesn't have like any kids to run around after or anything like
See,
that.
I knew you were going to say something mean like that, Dave.
Like I said, Nate's a good punching bag.
Yeah.
All righty. Well, thank you, Nate, for that.
There were years in this company where everything was my fault. So anytime I can throw shade on somebody else, I'm going to do it.
There you go. Today, I'm going to cover the wrap order training. I like to recycle this one every few weeks because we get a lot of new faces in here. And just curious from the chat, give me a yes if you are newer to the opening playbook, if you haven't been around for one of the full options training on the wrap order or how we do debit spreads. Just curious. I know we had some people come in from YouTube over the last week and a half. We did a little special show with Bridget there on YouTube. I know we had quite a few people jump in from there. So I promised you guys we would be covering this again. This is the basic wrap order training. So if you've traded options before, you've probably traded call or put, but very few people have traded spreads. And a lot of times that's because it sounds scary at first or complex or confusing. And actually, if you go on the internet, a lot of people will tell you that, but I think they're dead wrong. I think that, one, it's much, much easier than you would imagine. And number two, my hope is by the end of this training today, your eyes will be opened to see not only how easy it is, but how much better the risk to reward is. It is miles different. So we're going to go through it in a very slow manner today because I know we got in the chat a bunch of yeses. I want to make sure that everybody can digest this, understand this. Again, this is recorded in the opening playbook members portal. It's $1 for lifetime access. We had to charge more than $0, so we decided to go with $1. And you can review this content after today as well, so you can really understand it. But pretty much everything we do, for the most part, we will do basic calls and some basic puts, but for the most part, the majority of what we do is trading debit spreads, and you will see why in this training. So I really wanted to make sure that everyone has a good foundation there. So Nate, Dave, anything else before I dive in?
No, I think you got a lot of yeses in there from people who are new. And I would say if you watch this training, like Graham said, you probably want to review it a couple of times. But if you watch this training and then back to back with my how debit spreads work training in the opening playbook VIP, I personally think those are the two most valuable things you can do for your trading as a retail trader. I know it's a big bold claim, but I really believe in this structure and that style so much that I think if you do watch this training and then go into the opening playbook VIP, which is literally $1, just like Graham said, we had to charge something to give you a members area. Those two trainings, I think, will set you up to understand the opportunities in the market better than 99% of traders who never understand those kind of structures. So other than that, I would say carry on, and hope you guys enjoy this because I think it's one of the most foundational things that we do here in our opening playbook and our services and kind of everything else that we trade.
Yep. Awesome. And if you guys have seen this before, don't worry. We will do live trading today as well. So there will still be something for you. All right. Let's dive in. This is the wrap order training. I call it a wrap order for a very specific reason. I don't think anyone else in the world uses that name that I'm aware of, but it will all make sense here in a second. So my name is Graham Lindman. If you are new to the opening playbook, just want to introduce myself. And today I'm going to share with you a very special type of options trade that can completely transform your trading experience. It's been transformational for me. Here's some of my brokered screenshots. These are probably like a year or 2 years old. I've been doing this for a long time now and been trading this way for a long time. But I've also been able to enjoy the stories I've heard from other members as well. And we get them every day here in the opening playbook. It's very, very awesome, humbling, and encouraging when I see other people using this style of options trade to make money on their end. That's obviously our goal here is, yes, we want to make money. We put our own money in our trades that we share with you guys, but we also want to see you making money too. So the wrap order is a unique way to target right around 100% ROI, so a double, each and every week from a tiny move in a stock. And I really do mean a tiny move. That's what makes it so special. We're able to double our money even when stocks gain 0.5% or 0.3%, 0.7%. Usually right around 1% or less gives us enough to double our money. Now, really quick for you newer folks here, who here in this room thinks they know how to turn a 0.5% move in a stock into a 100% ROI gain? And I do truly mean 100% return on investment. There's no fancy math here. This is as straightforward as it gets. You put in $1, you have the opportunity to walk away with $2. Put in 500, opportunity to walk away with 1,000. So if you know how to turn a 0.5% move in a stock into a double, post in the chat. Well, I doubt that most people know how, because this is actually impossible with normal options. It's impossible to double your money on a 0.5% move. And most people have no idea even what a debit spread is, let alone a wrap order. You see, with normal options, you typically need around a 5 to 10% move in a stock to see that type of return. You need a very, very big move in a stock, and then your options can double. But I'm able to do that when a stock gains less than 1%. Now, it could go up 5%, it could go up 10%. That's great. But I don't need that to see my double. Oftentimes, I need less than 1% to double my money. Now, I've been trading this way for years now. In my original portfolio, trading these wrap orders has been awesome. Probably heard me talk about the perfect income trade alerts before. We have our average winner is right around a double, right? Because that's what we're always shooting for. Average weekly return has been really strong. And when you compound that over a year, I mean, this isn't even that pretty of a win rate, but when you compound this risk to reward over a year, the annualized gains really, really look good. That's 537% based on 15% of the account at risk. So that's a huge, huge number because of the odds we get with the wrap order. So I'm not kidding when I say that the wrap orders may be the most powerful tool in your options trading arsenal. They are for me, and I know that the wrap order is at least the foundation to the most powerful trading tool in many members here in the opening playbook and how they trade. So this is a basic debit spread. Basic debit spread. It's not scary. In essence, we're able to drastically reduce our risk, reduce option time decay, and reduce our cost of entry at the same time. So that's 3 positives right there. Less risk. We can eliminate time decay that normal options buyers see, and it's much cheaper to enter. Well, at the same time, we also get a better win rate. We also get a better profit factor, and we see a higher net return. I've done a ton of back testing in my time here. I've been at it for 15, 16 years now, and almost every single time, the P&L is much, much better with this application that I'm going to teach you today. In fact, the 60-minute income trade, which is one that I launched this year, we did the testing on it. I don't want to give too much information because it'll take too much time, but it's a morning breakout trade. We tested it with basic options. We tested it with out of the money options, in the money options, credit spreads, debit spreads, all sorts of things. And the wrap order came back as the most profitable way to trade it. So let's go ahead and dive into the specifics of how it works and how you can take advantage. So in my programs, I've already covered basic options that we can use. Buying calls, buying puts. This is the most basic way to trade options. And I would assume most of you guys here have probably done that before. So calls, you win if the stock goes up. Puts, you win if the stock goes down. It's a way to leverage your returns. But that's only in theory. That's not the whole truth of it. You see, the big problem with buying calls or buying puts is this factor called time decay. In essence, when you are buying a call option, you think that a stock will go up. The problem is the longer you hold that option, the more that the time premium loses value. And that's why sometimes you can be totally right about the direction of a stock. You can time everything up, go long, everything looks good, no stock moves, but you still lose money with call options. For example, here we go. Let's look at my trade on Apple. This was a trade I took last year on Apple. I entered on September 20th. I did a bullish call option. Apple gained 2.6% on the stock, so I was right about the direction. Looks good. Everything looks awesome. But here are my options. I took a screenshot of them for you here. Stock moved higher. The calls are supposed to go up, right? Well, no, I was down almost 20% on the options. So how does that make me feel? When you're right about the stock, you've done everything right, but your option loses money, makes you feel like you're running into a brick wall. Now, the truth is, if I'm trading a stock like Apple and holding for, let's say, 30 days, I would need at least a 4 to 5% move on that stock just to break even on my investment. So you need a huge move just to get out unscathed. So you probably won't hear this on YouTube or CNBC, but I'll tell you the truth. For the most part, generally speaking, buying calls, buying puts is no good, no bueno. In fact, you may have heard this stat before. The CME, the Chicago Mercantile Exchange, discovered that up to 76% of options actually lose money, even if you're right about the direction. And it can be so frustrating. It's hard enough to try and figure out which direction a stock's going. And if you're on the right side of that, you think you should be making money. But with basic options, a lot of times that's not the case. So the question is, do you see why trading basic call options can be such a losing proposition? But here's the cool part. During that same stretch with Apple, that same screenshot I just showed you, by using the weekly wrap order instead of just buying calls, over that 4-week stretch, we had 4 weekly opportunities. Now, keep in mind, there's winners and losers. I'm going to show you everything. Apple here, week 1, we doubled the money. 98% return on investment week 1. Then, because we were still long Apple, we got to do it again. Well, this one didn't work out. The stock went down. So we took a loser there. But again, we're still long Apple, so we do it again, 85%. And then again, the last week here, 110%. So as you can see, when you net out the winners and the losers, that's a 193% return on investment during that same stretch that the call options lost money. And yes, this is a real life example, real money example, real trades that I actually personally took and shared. So the question is, what would you prefer? Basic call options, you're right about the stock, but you lose 19% on the options. But the wrap order, by just applying a little different variation of options, we made 193% during that time. So again, put $1,000 in, you lose $190 with the call options. You make $1,930 with the wrap order. So this is not a trick question, right? I think we all would easily see this and say, well, I don't want to be the loser. I want to be the one making 193%. So let's dive into how the wrap order works. Now I'm going to walk you through it step by step, and it might seem complex at first, but again, this is recorded. It's in the members portal. Watch it over the weekend if you have to. Once you get the hang of it, they're very easy to do. Plus, the session will be recorded for you to review. So wrap orders are a simple debit spread, right? So it's just 2 calls together. However, I call them a wrap order for a very specific reason. It helps us remember what strikes to pick. And that's because we always wrap the current price of a stock with 2 strikes. So for example, this is theoretical here, but let's say Apple's at $100 and we're long Apple. We think it's going up in price. We would then wrap the current strike or the current price of the stock with the 99 and 101 strike call options, right? So we're wrapping the current price with the 2 strikes. We win if the stock finishes above the higher strike price. That's how we win with this. So here's what the order would look like. And again, this is a theoretical example, so don't rush to your brokerage to try and take this trade. If Apple's at $100 and you want to do the wrap order, you would buy the 99 strike call option. Again, probably everybody here's bought an option or a call option before, so just very basic there. And at the same time, you would sell the 101 strike call option. So you're just doing 2 call options together at the same time to create this wrap order debit spread. Now, we should always look to enter for around half the difference of the 2 strikes. So in this example, 101 and 99, anyone know what the difference is there? $2 difference in the strike prices there. So we want to enter for roughly half that price. So around $1 debit to enter. Now, the most we can lose is the amount we pay to enter. Just like with trading basic call options. If you buy a call and it's $5, the most you can lose is that $5. This is a debit spread. It's the same thing. There's no what you're paying is what you're risking. So the most we can now win, though, is the difference of the strikes, which, remember, that was $2. So that's a $1 to $2. That's 100% return on investment. So if we're wrong, we lose. We lose. It's plain and simple. We still have to be right. But if we're right, we win 100%. If the stock stays flat, this is the other cool part, we actually end up breaking even, unlike normal call buyers. Normal call buyers lose money on time decay for the most part, depending on the exact fill you get, but we get very, very close to break even, sometimes even make some money. So wrap orders are designed to be as close as possible to a 1-to-1 risk to reward ratio. In other words, if we risk $100, it's to make $100 in profit. Now, the reason why the 1-to-1 risk to reward on wrap orders is a winning proposition is because over time, stocks tend to go up. If you look at a chart of the S&P and you zoom out, it just goes up. There are pullbacks. There are dips along the way. There are losers. This is not something that you win 99.9% of the time with, but we know that stocks like to drift higher, so we can take this with really good odds. That means we can generate casino-like odds just by being consistent with our trades. So the question is, how do we actually win? Well, we win if the stock closes above the higher strike in the wrap order, then we make around 100% ROI. So in this example, we said Apple was at $100. We're wrapping it by buying, and we had a clarification here in the chat. When you're entering the trade, buying to open on both of these trades. Buy to open the 99 strike call option, buy to open or sell to open the 101 strike call option. We win if Apple closes above that higher strike. So if Apple's above 101 by expiration, we would double our money. It could be at 101, 102, 103, etc. As long as it's above 101, we make max profit. So to help solidify the power of these wrap orders and why I believe they're so much better than normal options buying, well, let's walk through some scenarios to compare the power of wrap orders with call options. So remember, in this example, let's say Apple is trading at $100 and we do that 99-101 wrap. We wrapped the current price of the stock with the two options. Let's look what happens. Well, let's say we're wrong. Apple drops, it goes down below 99 by expiration. With the call options, you lose, right? It goes down, you lose money on call options. With the wrap order, you also lose. This is still a directional trade. You still need the stock to go higher. Scenario 2, though, if Apple stays flat, stays at $100 by expiration and went nowhere fast, with the call options, you lose on time decay. Remember that example I showed you? The stock gained 2% and I still lost on time decay. With the wrap order, we actually end up breaking even because by doing the spread, we're offsetting the time decay. Now, for scenario number 3, let's say Apple barely moves. It moves 50 cents by expiration. Again, with the call options, you're going to lose money on time decay. With the wrap order, you're actually going to make around a 50% return on investment. The stock barely even moved, and you make 50% return on investment. It gets even better, though. If Apple goes to 101 by expiration, it moves 1% during this time period. With call options, you might get lucky and break even, although I doubt it. Because remember, my example moved 2.5% and we still lost money. But let's just say, for example's sake, you might get lucky and break even. With the wrap order, you're going to double your money. Let's say Apple keeps going. Apple goes to 103 by expiration. With the call options, you might make 20 to 30%. Woohoo. With the wrap order, you make 100%. 3 to 5 times the return on investment. Now, let's give a very rare scenario. Let's say Apple goes
Graham.
to... Yep.
Graham, let me interrupt you because a bunch of people are saying they lost sound. Let me just have everybody refresh their browser real quick because I hear you fine. And I see you fine in WisePub as well. Let me just give...
It looks like on the page, I've got the page open here.
yeah. WisePub is frozen. Yeah. Let me just refresh it. Not sure what's going on with the stream. I realize
there's saying refresh.
Yeah, it's not working for me in WisePub.
Okay. Yeah, me either.
it's obviously not your feed because I'm not coming through on it. The page isn't coming through, and we're fine in StreamYard. So it looks like it might be coming back. Get a nice long sigh in there for the recording.
All right. Is it working now?
Yeah, I think so.
Okay. I've got an echo now.
Yeah, it's probably on my end. And make sure if you refreshed that it didn't unmute the presentation in WisePub, but I had it unmuted, so it might have been my echo.
Okay. Cool. All right, we're back. Sorry about that, everyone. So again, we've got these couple scenarios we're walking through. Again, this is a directional trade. We need the stock to move up to hit our full double. Again, if the stock goes down, call option to lose, wrap order, we lose. It's the way it works. It's trading. If it goes flat, on call options, you lose money on time decay. You'll lose a good bit. Wrap orders, you'll actually get around break even. If the Apple barely moves, if it gains 50 cents in this example, call options, again, you're going to be a loser. You're going to pay for time decay, that time premium eating against you, that silent cost. With the wrap order, you're actually going to make around 50% return on investment. It's pretty awesome. Scenario 4, let's say Apple goes to 101 by expiration. With the call options, you might get lucky and break even, although I doubt it. I bet you would lose money on time decay. Again, I had that example on Apple earlier where it gained 2% and I still lost money. But we'll give call options the benefit of the doubt here and say you get lucky and break even. With the wrap order, you make 100% return on investment. Let's say Apple keeps going. Let's say Apple goes to 103 by expiration. With the call options, you might make 20 to 30%. Woohoo. With the wrap order, you're making 100%. You're making 3 to 5 times the return by just using the correct options application. Now let's look at a very rare scenario. This is where call options can be good. They have unlimited upside. Wrap order, we're capped. We have a max profit, but again, that's at 100%, pretty darn good. But let's say Apple goes to 110 by expiration, which would be a pretty rare move. With the call options, you'd probably make 100%, maybe even more. With the wrap order, you would make still that double, that 100% profit we're going for. So in conclusion, if we look at the 6 different scenarios here, with the call options of the 6 scenarios, only 2 are winning outcomes. With the wrap order, however, by just using what I think is the better options application, 4 of those 6 are winning scenarios. So 33% winning odds with call options versus 66, 67% winning odds on the wrap order. Now, if you ask me, that's casino-like odds by just staying consistent, knowing there's going to be good stretches, bad stretches, all in between. But over time, stocks like to go up. So by using this options, by using this wrap order, I think you've got really good odds. So to recap, how does this work? And David, I know we've got a lot of questions in the chat. I'm going to answer them all here. And the presentation actually answers a lot of your questions that you have. So we'll get to it. We've still got plenty more to go over. But a wrap order is a debit spread. They're the same thing. This is a debit.
It's a specific type of debit spread, right?
It's just a debit spread. I call it a wrap order because if you say debit spread, you could be trading any strike out there. If I say wrap order, we know we're doing a debit spread at the money, wrapping the current price of the stock. It's just an easy way to remember what strikes we're picking. So, for example, if Apple's at $100, we would then wrap the current price with the 99 and 101 strike call options. So in this example, you would be buying to open the 99 strike call option and selling to open the 101 strike call option. Again, just wrapping that price. And you want to enter for about half the difference of the spread. And yes, it is also called a vertical spread in some brokerages. And Thinkorswim is called a vertical. So visually, this is what the wrap order looks like. If Apple's at $100 and we think it's going up, we buy that lower call, the in the money call, and then we simultaneously sell the higher call, the one just slightly out of the money. wrapping the current price of the stock. And that's why I give it the name, the wrap order. So if Apple closes above 101, in this example, you would double your money. And that's about a 1% move on this stock. So how can you calculate the risk to reward? Well, the order calculators are in all of the paid membership portals. It's in the opening playbook portal. Nate made a very cool one for us, and we'll cover that here in a moment when we do a couple live trades here. But first, let me give you another practical example. In my On the Clock Stocks program, I did a buy alert on Google. In the first week, the stock went up 2.1% in about 3 days. Pretty good. Now, I gave both the call options and the wrap order to the members just so they could see for themselves the difference. In the first week, the call options were up about 30%. That's pretty awesome, right? But the wrap order was up 81% by the end of the week. So in this example right here, it's about 3 times the result just by using a slightly different options play. And all I needed was a 0.7% gain in Google stock by that Friday to make my full profit potential. I did not need a huge move, just needed a fraction of that. And if Google was still bullish, here's the cool thing. If you still like a stock at expiration day, you can then just enter another position again for the following week expiration and target around 100% ROI again. And that's exactly what happened. We ended up closing out week 1 with 74% on the Google wrap order, in week 2 with a double. So in about 2 weeks, add those up, 175% total return on investment in 2 weeks. Now, in this example, the call options did excellent. They made 132% for the members. Everyone should have been very, very thrilled. But again, the wrap order still outperformed, even in a best case scenario for the calls. And if the entire wrap order is in the money at the end of the week on expiration day, your brokerage should automatically exercise both sides and offset the calls for a max profit. You can always sell it early if you want to and get close to a max profit. However, if you hold it through expiration day and you're all the way in the money, they offset for a win, for a max profit. Now, if the spread ends up in the middle, where the price is in the middle of your spread, you can just sell it on Friday before 3 o'clock, give or take. Some of the brokerages are different on when you would want to sell it by. But if it's somewhere in the middle and it hasn't moved all the way in the money, I like to close it out Friday before the bell. And in that case, you should still get a really, really solid return on investment. In this case, if Apple was at 150 cents, you would get about 50% return on investment from just a tiny, tiny move. Now, of course, in my premium alert services, I do the heavy lifting for you. I send you the entries, calculate the odds, give you the exact options and the exits. But if you would like to manage some of these types of trades on your own, or if you want to paper trade a few, get the hang of it, get the feel for it, let's go check out the calculator and put it to work. So we're going to leave the PowerPoint here and head over to the members portal so we can do that next. One moment. So if you have a membership with us, I'm just going to go show the opening playbook one because everyone should have it. And I know we have a ton of questions in here on how much time do we exit early? When would we not use a wrap order? We're going to cover all that here. But first, let me just show you this really quick. In the opening playbook members portal, and this is all the members portal, if you come here to the calculator portion, this is the old one that I made, and then Nate made a cool new one. Just use this opening playbook debit spread calculator because it'll do it all for you, and it looks much prettier, in my opinion. But here you can enter in all of the information of the option you're trading, the entry price, the contracts you're trading, and if you want to use a profit target, which we'll cover in a moment, you can do that too. But again, we just said with that example, the theoretical example, we were doing buying the 99 call, selling the 101, entering for $1. Here you can see the ROI potential, and I'm not sure why this says profit potential is 0. Entry price $1. Uh-oh. Might have to give Nate a hard time here. Oh, it's because that was blank. All right, there we go. Now we're good. All right, so this is the example I just told you about. Calculator does everything for you. It tells you your max risk, your max profit, max ROI, all of that good information. Don't worry about the targets just yet. We'll cover that in a bit. But this is the calculator right now that you should be using for your wrap orders. So let me go back here to the wrap order training. And we will come back and use that here for some live trades in a moment. But again, let me just really quick cover some basic rules of when I like to apply wrap orders versus avoid them. Now, the key to wrap orders is you want a strong stock with weekly options. This is my general go-to. I want to see a good strong stock that's trending higher and that has weekly options so that I can apply this week after week. Because of the way wrap orders are designed, you can trade even some of the most expensive stocks for just a fraction of the price. For example, I don't know what it's at right now, but ServiceNow is trading around $1,000 for the stock. And if you wanted to buy the call options at the money, they were about $3,000 per contract. So $30 contract nets out to $3,000 to take one position. And you have to hope that now rallies hard, at least 3% plus to break even. So not only is it very expensive to enter, but you need a big move just to break even. But that same wrap order was priced at $250 per contract, and you only needed ServiceNow to gain 0.1% or more by the following Friday to double your money. So here you need 3% to break even. With the wrap order, you need 0.1% by next Friday to earn 100% return on investment. So how would you prefer to trade a stock like that? Call options, $3,000 a contract. You need a 3% move to break even, and you would need a 10% or more to gain a meaningful return. However, with the wrap order, $250 a contract, you don't need a move to break even. It could be 0% and you break even, and you needed 0.1% or more to double your money. In my opinion, it's a no-brainer. And in this example, it's literally 100 times easier to hit your profit, right? Instead of needing a 10% gain, you need 1/10 of 1%. So let's go look for a live example and use the calculator. And I'll go to the chat too and answer some of the questions here as well. Wrap orders, it's using options, so it ends up being leveraged, just like options would be. Let me make this bigger for you guys. Oops. So you can see it a little better. Oh no, I'm going to lose that whole thing. Alrighty. We're asking about what strike. You just wrap the current strike, or the current price. So let's look at GEV, actually. It's just one I have up here. This is an awesome stock. It had a good pullback this week. It looks like it's moving higher today, 3.3%. This is one of my biggest stock holdings right now. It's been a monster for me. Right now, GEV is trading at, we'll call it $600 a share, just for example's sake. If you want to trade, let's just look apples to apples. If you want to trade next week's call options, they are $1,700 a pop, $1,700 a pop. However, what I'm going to do here is I'm going to look at what the wrap orders are priced at. So again, here's the price right now. We want to wrap the current price with two strikes. So right now it's kind of at $597.50. So we'll take a look at $595 and $600. Again, buying one lower, selling one higher. So I'm going to look here. I haven't looked at this, but see if it's any good. This is not that great of pricing here. And this is where Nate's income machine really is helpful because it vets all of this for you in advance. But we'll see. We'll see what this does. But right now, given the current price of GEV, if we wrap it with the $595, $600, it's at $280 net debit. I would like to see this at about $250 because, again, we want to enter for about half the width of the strikes. So it's a $5 width here. We want to enter for around $250. Let me just throw this in there just to see if it'll fill. All right, it's not filling right away. I just saw it was a little bit wide here. So sometimes you can sneak an order in. All right, it's coming down now. We'll go with this one right now, and I'll just say set a limit order at $250, and if it fills, great. If it doesn't, no worries. So we like GEV. It's a good, strong stock. The momentum is still red, but it is popping above the 50-day moving average. It's actually setting up a gap fill, which we've been talking about lately. And the current price is $596. So I'm going to go pull up that calculator again, wherever I put it.
Do you want me to post that? The 595, 600?
Yeah, that'd be great, actually. All right, here's our calculator. So again, we're going to buy the 595 call, and the expiration is next Friday. So it gives us a full week and a couple of days. So here, I'll just post this in here. GEV.
I got it.
Buy. Oh, there you go. Thank you. Perfect. All right. Where was I? Okay, the calculators. So we're buying the 595 call strike. We're going to sell the 600. Very easy. We're putting that in the calculator. We're going to set our entry price at 250. We can bump it to 260 if we need to. It looks like that's where it's trading now. But for example's sake, let's look at this. Right now, that is $250 risk per contract to double our money. We can see that all here. If we enter, let's say we enter for 260, the calculator does the work for you. And with the wrap order or debit spreads, you want to enter for the lowest price possible. But here we have an entry at 260, and it gives you the same odds. It also tells you the ROI percentage, 92%. All right, so what does that really mean? Well, let's look at the chart of GEV. With these strikes here, again, we did the 595 and 600. We would want GEV to close above 600 by next Friday. So with the normal call option, it's $17. Let me just show you here. With the normal call option, you need it at 615, roughly speaking, 612. So you need it up here to break even. Let me just zoom in more. Normal call options on 912, you need it about here to break even. If you want to double your money on normal call options, you need it to go right about here to make 100% return on investment. All right. Now, on the other hand, with the wrap order, with that 600 and 595 strike, we only need GEV to be above here by that date, 912. So as you can see, we need a very, very small move in GEV to double our money. So let me go ahead and tell you exactly how small of a move that is. We need it above 600. It's at 596, 180, or 18 right now. We need a 0.6% gain in the stock to double our money. It's up 3% today. So we need not even 1%. We need 0.6% on GEV to double our money. That's why I love trading this way, because it does not demand a big move for us to get really, really great results. Now, again, if GEV closes below 600, we're going to lose. Just like with call options, if it doesn't, in this example, if it doesn't go all the way up here, you're going to lose. But here, we need a very, very small move. So let's go ahead and see what it's trading at now. It's at 265. I'm just going to go ahead and send it off for example's sake. See if I filled right away at 265. No problem. Again, typically, I like to get as close to half of the strike width here, but I did 265, and our calculator will do it all for me. So again, if GEV gains 0.6%, I make 88% return on investment. It could gain 1%, it could gain 2%, it could gain 3%. As long as it's 0.6% or better. Oh, wow, you got filled at 250? Good for you. I make 88% return on investment on a very, very tiny move in GEV. Wow, 252. I should have been more patient. The name of this program, this isn't a program. This is just me teaching you guys how I like to trade options. So hopefully it helps benefit you and how you're trading as well. What questions did I miss? This isn't futures. This is options. But yeah, Josh, you can definitely start out in a paper account. I know that some folks said that the fills, it's going to give you better fills. So your simulation returns will look better than real money. However, it will be good just to practice selecting the options, making sure you have everything set right, and just getting the reps there. Wow, everyone got filled at 250.
Yeah, a few of the questions were, why do you choose a week-ish out as opposed to longer?
So that's a great question. And that is something that you kind of have to answer for yourself. So this is something I should have said from the start. I try to remind you guys, the wrap order is not a strategy. I don't go out there and say, all right, I'm going to be a wrap order strategy trader today. No, the underlying strategy is what demands your expiration. So, for example, let's look at 60-minute income, for example. That one's a day trade. The strategy is saying we're going for an intraday move on the S&P. So because we're only holding it for 1 day, then I would use that same day expiration. My perfect income, I hold for a week. So that one tells me I need to hold it for a week. I had a lightning trades program, which was a month. The strategy demanded that we're going to buy a stock at the expiration date, or, the middle of the month, and hold it for a month. So with that, I would use a 1 month expiration date. Oh, there you go. I got filled for 250 on GEV as well just now. So typically I use 1 to 2 weeks. However, if you were in our dream portfolio that we did on the pullback earlier this year, we gave those like 6 months, 12 months. And that's the really cool thing here with wrap orders. You get to pick the time. So here's what's crazy. Let's just look. And I don't know what this is going to tell me. Okay. They don't have the same exact strikes. So it's going to be a little different. Let me see if I can find one with $5 strikes. Let me go to Apple.
I answered this question already in the chat, but it's flown by at this point. So your risk on these is just the amount of the debit. So if you got it for 250 or 255 or 260, that's your total risk. We call it defined risk. So getting into it that what you're willing to pay for that debit, that is your total risk. The worst it could do is just go to zero.
Yep, that's right. I'm trying to find a cool example to show you guys. So right now, this is an okay example. There's normally ones that are way cooler to see. But right now, if you wanted to trade Apple and say I'm long Apple, I think it's going to go up over the next 10 days, September 12th. You can do that with the wrap order for next Friday, enter for 274. Or on the flip side, if you say, you know what, I don't know if Apple's going up over the next week, but I'm very, very confident that Apple's going to go up through the end of the year. Look at this, 276 right here for next week. If you want to buy, it says 290 now. It was 270. But a lot of the times on individual stocks, you can go very far out, give it plenty of time to move in the money, and enter for around the same risk to reward. It's really, really shocking. I wish this one lined up here because it just did for me, but it was at 275. So I could basically get the same return on investment by giving Apple more time to move higher. I mean, by November, it could be all the way up here, well above my strikes. But that's just something that you have to decide for yourself. Do you want to hold a position for a week? Do you want to hold it for a month, 2 months, 3 months, 1 day? That's where the underlying strategy is important of why you pick the expiration. So I did the 12th of September expiration on GV. And Lynn, you have a great point. If the stock is expected to make a big move, you might not want to use a wrap order because your limit or because your returns are capped. Your max ROI is about 100%. So, for example, we've talked a lot about Rocket Mortgage lately. This stock has been moving like crazy every day. It might not make sense for me to use a wrap order where I need a 1% move. I might go a little bit more out of the money because I know it moves 2-3%. That would be my elite trade, which we'll do a training on that here again shortly. Also, Nate does the same thing with his jump trades where you go out of the money for better or for bigger return on investments.
Just to recap something you said earlier, make sure I have it right and other people understand it. So the width of the spread could be $1, could be $2.50, could be $5, and you're really assessing how much is it costing you to get that width, right? So if you're paying $2.50 for a $5 width, or you're paying $1 for a $2 width, they're the same ratio, right? So it doesn't really matter unless you don't want to invest that much,
right?
Like it's the cost compared to the width, not just the width,
right? Yeah. So and if you do a $1 spread, like a stock I'll just show you here.
Right. So if you're spending $1 debit, but you're getting a $2.50 spread, then you've got a better risk reward ratio than $2.50 to $5.
Mm-hmm. Yeah. So here, let me find one that's $1 width, and you can see for yourself too. Let me get on my list of stocks. I don't think they have dollars. Okay, we'll do, I don't know, I've been burned on Hood twice in a row, so I'm going to pass on Hood here, even though I really like the stock. Meta is another great example. This one's been awesome for me. Same thing if you're looking at the call options, $1,300. If you look at the wrap order, a little over $100. So if you want to apply this on Meta, but let me try and find one on my list here. And if not, I'll flip to my, let me just do this. Where is my good friend O'Reilly? All right, O'Reilly. So this one, the underlying strategy would probably call for more time. And in fact, we have one open right now from the opening playbook that's up 70, 80% or so. But O'Reilly is a very strong stock right now. Weekly momentum is very positive. Apex has a positive signal, which, by the way, I should have mentioned this earlier. We've got a huge, huge upgrade coming for the Apex members. It's going to be so cool. Maybe I'll give a little sneak peek here at the end of today's class. But O'Reilly looks really good. Let's go ahead and look at the wrap orders on O'Reilly. Now, this one doesn't have weekly options. So we'll go to the 19th of September. Oh, no, I'm going to really hose myself. Oh, wow. They did a stock split, so all their options are. All right, well, this was a terrible example, which, again, is why these automated systems that pull the options for you are great. I would like to see $1 strike here, not $5 strikes. Well, that one really backfired on me, but I was going to show you O'Reilly. You can get a wrap order and it's for much cheaper. All right, back to the Apex list. Let's see what we got here. Lily. I wanted to find a cheap one for you guys to show you. And that's why I thought O'Reilly was going to be awesome. All right, what stocks do we like this week? Was there any ones that we mentioned earlier this week that I said we'd come back and trade?
I don't remember.
Okay, BSX. This one's a monster. I think we traded BSX this week. I think I have an open trade. Oh, maybe I don't. Maybe it was last week. All right, let's look at BSX here because they have dollar strikes, so this will be perfect. All right, this one's long on Newton momentum. Great trend, strong stock. It's at $100, $107. Oh, cool, Rick. We'll do Walmart next. BSX is a great one. Oh, GE is tempting too, but I think they have 250 strikes. Yeah. All right, we'll do BSX, GE, and Walmart. So here on BSX, again, good, healthy trend. If I want to trade the wrap order for next week's expiration, again, I'm September 12th, and I'm going to wrap the current price with 2 strikes. So price is 107.50. So we're going to buy the 107, sell the 108. We are wrapping the current price. Right now, this is at 55 cents. I'm going to set a debit here at 50 cents to see if I get filled. Again, it's a little bit wider, so make sure you're using a limit order. But here in this trade, again, I'm entering for 50 cents a contract. My max profit is that $1. So it's a double, 100% return on investment. I don't need BSX to go crazy to the moon. I just need BSX by September 12th to be above 108. So right where my crosshairs are here, if it's above that line, that horizontal line by that vertical date shown, I would make 100% return on investment. As you can see, it was already above that line today. So it's a very, very small move. I will tell you the exact move. We'll just call it 50 cents because it's moving, but 50 cents to get above that line. We need a 0.4% gain in the stock to double our money. 0.4% or more. So let me go ahead and send this off. Again, the bid ask is a little wide, so I'm going to use 50 cents. The cool thing is that Thinkorswim will do the math for me here. But let me go ahead and ship this off and let it sit, and we'll move on to those other tickers that we talked about. Where do you put how much you want to bet? Good question. So here in the calculator, I'll punch this one in here. Oh, I never typed it in the chat.
Yeah, sorry. I was busy typing to other people.
All good. BSX by 12 September. 107 call.
There are a lot of people asking questions about, exits and holding and early and all that kind of stuff. Folks, when you get into, if you take the dollar membership or you get into any of Graham's programs or even Nate's programs, there's plenty of training that explains to you how to manage these types of spreads, why we typically hold them till expiration, why you might want to set a target and get out early, all that kind of stuff. It's really difficult to go into all those details in like a half-hour program or an hour, but there are hours worth of training and on all this in the members area. So that's why we have those recordings.
Yeah. So how much do you want to bet? Well, again, if you just put the information in here, and again, maybe we enter for 52 cents. We'll see how it works. But here's based on one contract, you can just up this as much as you want. And again, risk is how much you're willing to bet. This is how much the max ROI is. And if you want to use a target, which again, we have full trainings on that. Nate covers that all the time. You can put in here, I want a 50% target. Okay, here's the limit price to use. I want a 70% target. Gives you all of that information right here. It's really, really cool. Obviously, I've already eaten up the whole hour here. So won't have time to get into that today, but we do cover that, and it is recorded in the portal. So this is a good, easy way to see how much do you want to risk to, risk to reward. What do you want to set it as? What was the ticker I said I was going to do next? Walmart. Nate's beloved.
Steve
Walmart.
just asked whether that should be 106, 108 instead of 107, 108.
No, good question. So it's at 107.66. So I just bought the 107, sold the 108 because it was in the middle. I was able to wrap it. Versus if this was 107.00, then you might do the 106, 108. Hope that made sense.
Yep. And how much did you pay for it?
I put in a limit order at 50 cents, but it's going to be a little bit higher now because BSX is moving higher on us. Let's see. Probably 60 cents. Yeah, 60 cents right now. But again, if you can set the limit order, see if you get filled. That GEV one, I set a limit order and it took a couple minutes, but it did end up filling. I don't know where BSX is going to go from here. But again, if you just want to enter for 60 cents, again, this does the math for you. That's a 67% return on investment. I don't like to enter for, I like to get at least 80% return on investment, which would be about 55 cents debit. But we'll go look at Walmart here to see if we can get another trade here. So Walmart was the one Nate liked yesterday. Looks beautiful. Look at that momentum at the bottom, peeling back to the upside. It's not green yet, but we're seeing that exponential move higher. Nate liked it. I don't know exactly what his reasoning was, but I trust Nate. So let's look and see if you want to trade a wrap order on Walmart. It's at 150 cents. So we can use the 100 and 101 strike call options. Let me see if I can get filled at 50 cents. All of these are a bit pricier today, which is a little bit shocking. Normally they come right in at the middle, but it's at 53 cents now. So Walmart, buy 100 strike call, sell 101 call. Again, we're just wrapping the current price. Current price is 150 cents. So we're buying 100, selling 101. It's at 54-cent net debit right now. So let me go punch that in the calculator. All of these are a bit pricier today than normal, which is unusual. Maybe there's something to that. But still, you can make an 85% return on investment with this trade at expiration. If Walmart closes on the 12th above 101, which you can see by my crosshairs is right here. So given the current price of the stock, you need it above 101. It's at 156. It needs to gain 0.4% over the next week for you to get that return on investment. So it's up 1% today. It does not need to do 1% again. It just needs 0.4%. I like to say it just needs to drift in the direction it's already headed.
I'll answer a couple questions because you've already answered them 2 or 3 times.
Okay.
Yes, this is being recorded. We record every single opening and closing playbook. The link for the replays is in the announcements below the presentation. And the link to them is also in the members area of the $1 opening playbook membership. The reason we call it a wrap order is because it is a vertical call spread like you suggested, but it is specifically a strike above and a strike below the current price. So it's one in the money, one out of the money, and that's why he calls it a wrap, because it wraps above and below the current price.
Yeah. Can you set a target to exit early? Yes, you can. We don't have time to cover that today. We will get it on the docket to cover again. But basically, you would just set a closing order on that spread after you fill and set the price you want to get for it, and then make it good till canceled so that if at any time it hits that, you can take profits there. Thank you, Karen.
And keep in mind, the way you're calculating your percentage return is on the amount of the debit. So if you paid 50 cents for the debit and you put an order in, you want to make 50% on your money, then you'd put an order in for 75 cents. It's not based on the strike price, it's based on your debit price.
Yep. So a couple of rules before we wrap up here, no pun intended, and I know I'm over on time. But rule number one is I typically avoid stocks under $50 unless there are some exceptions, unless they have 50-cent strikes. But let's say they have $1 strikes and the stock's under $50. Well, why is that? Well, for a $50 stock, if I do that wrap order, 49 and 51, that means I need a $1 move on the stock to hit that max profit. That's a 2% gain for the week, which is definitely plausible for a stock. It's not out of the picture. But if I'm trading a $100 stock with $1 strikes, I only need a 1% gain on the stock to double my money. So typically, the more expensive the stock, the better your odds are. That's why like GV needed such a small move. Lilly's a great one right now. Meta's a great one right now. The more expensive the stock, the easier it is for it to get outside of your strike prices. And because options aren't fractional, that's why the higher the stock, depending on the strikes, there's some nuance to it. We're not going to go into all the details. You can run the numbers for yourself, but typically, the more expensive the stock, over $100 or more, the better your odds are. And yeah, the same general rules apply for stocks that have 250 strikes, $5 strikes, but obviously we don't have time to get into all that right now. But what I like to do is I just like to see what does that move required. So I'll take the strike that I would need it to get above and divide it by the current price of the stock. And that tells me if I'm in that 1% ballpark. I typically want a stock to gain 1% or less required to double my money. Rule number two, know your limits and be consistent. So never trade with more than you can afford to lose, because there will be losers. Winners and losers happen. And over time, if you can find an edge with a stock that is weekly options, I think that can stack up over time. And I apologize, I got to get this rolling here because I just realized I'm late to my next meeting. So rule number three, understand news and catalysts. You can trade wrap orders through earnings. You can get great prices on them. But if I've got an earnings event and it's either going to be binary up or down, I don't know if I want to use a wrap order there. I probably just want to avoid it. If the Fed is speaking and I'm up 80%, maybe take your profits. Why risk it for something that you can't control? Another rule, pair wrap orders with your favorite strategies. For example, like on the clock stocks, when the call options did good, the wrap orders did better. So again, this is an application for your underlying strategy. The wrap order is not a strategy itself. It's a way to leverage the returns on your underlying strategy. Another example, Newton. I use it with Newton all the time. Here's a trade I had on MicroStrategy using a wrap order. Awesome result. Another one, 60-minute income. This is our daily trade. So I use 0DTE options. This one actually has a target, which we didn't have time to cover today. But again, it's all from this foundational understanding of what a wrap order is, how it works, and how to apply it to your trading. So yes, you can buy calls, you can buy puts, or you could use a wrap order. That's what I like to do. So with wrap orders, we wrap the current price of a stock with weekly options, generally speaking. It's a debit spread aiming for about 100% return on investment by the end of the week from a small move in the stock. So for example, if a stock's at $100, you wrap it with a 99 and 101. It's like a hot dog. And you want to enter for about half the width of that spread, and your max profit is that full width. So in this case, 101 minus 99 is $2. That's the most you can get for it. And in this example, as long as Apple closed above 101, or as long as your stock closes above the strike you sold by expiration date, you make that full profit. So that's what I have here for the wrap order training. Again, we've got full recordings in the $1 membership portal. I highly recommend, if you're newer to this, if you want to be able to keep up with the trades we're doing, have fun and see some of those results, watch them over the weekend. We got football on this weekend, which is awesome. Football starts tonight. Very excited for that. But in the other hours of the day, maybe catch the recordings and get really familiar with them so you're ready to hit the ground running next week. Why not
red
just do it
zone
on
starts
gold all the
Sunday.
time? Aloha said you can do it on gold all the time. We've done plenty of wrap orders on gold. It's been a great one. Go Eagles. That's funny. I don't, a lot of people like loathe the Eagles or the Cowboys. I'm not too opinionated, but I'm not an Eagles fan. I need the Lions to win a Super Bowl.
We need to ask Mr. Pittsburgh how he feels about the Eagles.
Yeah, I forgot they've got Aaron Rodgers. That'll be interesting for old Nate.
Yeah, red zone Sunday.
Oh, nice. Missed part of the webinar. The recording is in the members portal. It's $1 for lifetime access. There you go, Luigi.
Yeah, the dollar access, the dollar membership, the link to that is in the announcements under the presentation. In fact, whenever any of you are looking for any links, first place to go is going to be under the presentation in those links there. But of course, if there's something you need that's not there, you can ask for it. I have the replay of your presentation there for on the clock stocks ready for the group here. If you want to jump to what you're late for, Graham, I can take over.
Perfect.
And go from there.
That sounds good. Again, this is just another strategy. And it's really cool with the on-the-clock stocks. We're looking at those seasonal picks that go up every year on the same dates. So that's how I time up my expiration. I know how long I want to hold it for, and I just find the closest expiration. So it's just a beautiful example of how do you know the expiration. This was the trade we took recently. Well, in the program, Google call options did good. Wrap orders crushed it. If you guys want to see how I'm trading with seasonal picks and want to follow along, we'll get that replay up for you guys. You'll want to stick around and check that out. And we've got 1 to 2 picks a week for that.
Awesome.